Well, I'll take that that generous hush as a sign to jump in and get us going. Thanks so much for joining us. Thanks for braving the slightly more clement weather than we've had the last couple of days. But I'll take your enthusiasm as a signal of engagement on what is a really important policy topic, and I'm really pleased to be able to chair what promises to be a kind of fascinating session from some real expert speakers on financial inclusion. My name is Aveek Bhattacharya. For those of you who don't know me, I am Research Director of the Social Market Foundation. We're a cross-party think tank based in Westminster that works across a wide range of policy areas, including economic policy and financial inclusion. You should sign up to our newsletter, Wonk Week, which summarises the work that we do and other kind of policy topics. If you got this far into conference, you presumably don't need me to explain how panel events work, but we'll do 5 minutes from each of the speakers. I'll ask a couple of questions of them, and then open up to the audience. Unfortunately, Torsten is squeezing us in, dodging the whips, but shh. so don't tell anyone. And we'll need to leave about 1:30, but should be able to make a contribution before then. So I'll just do a little bit of housekeeping. So for those of you on Twitter/X, we're at SMF Think Tank, at Fair4All Finance, #LPC24. There's no fire drill planned, so if you hear fire alarm out the door to your right, follow the exits. So without further ado, let's get to it. So I'm really pleased to be working on this panel event with Fair4All Finance, looking at how access to financial services can drive inclusive growth across the country. A recent study by Fair4All found that 44% of UK adults are financially vulnerable. 1 in 5 of them have been rejected for credit in the last year. So we'll be using this event to look at how we can boost opportunity through a local approach to financial inclusion, speaking to some organisations that have been working on the ground on that, and asking about what the new Labour government and what policymakers more broadly can do to address the issue. So we're going to start with Kate Pender, who's Deputy CEO at Fair4All Finance, and tell you a bit about their work and the policy agenda here.
Thanks very much. This is actually week 3 for me as CEO, so it's great to be here. Yay. Thank you all for coming. Haven't broken anything yet, so fingers crossed. So just thinking about why do we think that access to financial services can contribute to financial growth for the wider economy. It's probably worth defining what we mean by financial inclusion. And financial inclusion, as we think about it, is making sure that people are aware of and have access to financial services and products that are really able to help them manage their lives, to build their financial resilience, and to participate in society. And those things really need to come together in the totality of financial inclusion, and for that to be true for everyone, irrespective of their background, their income, or whatever their circumstances are. So we're really delighted that this new government, Rachel Reeves and Tulip Sadiq as City Minister, have made a commitment to have a national financial inclusion strategy. We think that's absolutely fantastic. And if we think about what that's going to deliver and what we're trying to overcome, the crux of it is that connecting people with the right financial services and products really increases their ability to participate in society. And without that access, there really is a drain on the economy. So Rachel Reeves put it really well in her conference speech last year. She said something like, you can't dream big if you can't sleep in peace at night. And you can't sleep at peace at night if you don't know that you've got something put aside for a rainy day. And unfortunately, what our research and those of many other organisations have showed is that there's just too many people who don't have that peace of mind. So So there are 20 million people, roughly 44% of the UK population, who are living in financially vulnerable circumstances. That basically means that they are either underserved or excluded, and they don't have access to those products and services that can help them. That, really simply put, is a drain on the economy. It's a drain on the economy in lots of ways. It means that people who are worrying about problem debt or not being able to pay their bills are more likely to miss work. They're more likely to keep their kids home from school because the washing machine's broken and they can't fix it or replace it. All of these things have kind of a compound effect. And the heart of that story is that for many people, many of us in this room, when something happens in life, we've got that resilience to cope with it. We've got insurance, we've got savings, we've got access to affordable credit. But for many other people, that's simply not there. And it doesn't have to be like that. So there are some really great alternatives that we've seen. We're here in Liverpool and Merseyside. We know that financial exclusion is higher here than in other parts of the country. This is a problem that's not evenly spread. It's heightened in Torsten's constituency, and you could look at pockets across the UK where that's true. But there are things that are making a difference in particular locations. So you'll hear from Karen from Enterprise Credit Union. Our research with all of the credit unions across Liverpool and Merseyside shows that credit unions and the products that they're offering have an 80% impact on their members' mental health and well-being. It's a really big uplift. We think there's more that the whole sector can do, and that there are opportunities for organisations to really address the gap for those 20 million people. So there is plenty of evidence that at present there is a £2 billion unmet credit demand, which could be served in a commercially viable, compliant way. So 20 million people excluded or underserved, a £2 billion market opportunity in the credit market alone. And there are similar anecdotes in terms of insurance, making savings and so forth much more easily achievable. And some of the investments that we've made tell that story quite impactfully. So we put quite a lot of money into a community development finance institution, Fair4You. We know that for every pound that we put in, there's an £18 benefit to wider society, including things like reducing costs to the NHS, because those customers have been able to get access to white goods, to keep the kids in school, to make sure that they can get to work and so forth. We've partnered with Treasury on a no interest loan scheme, which is really about helping those who have very fragile, thin or non-existent credit files, or for whom paying interest creates an affordability problem. And there's just one example from that I'd love to share. It's one example of 14,000 loans and over £10 million lent. It's a guy called Craig, who is an NHS mental health nurse, sole carer to his 11-year-old son. He really needed a £1,500 loan, and he couldn't get access to that because his credit file wasn't great. His circumstances had changed, but mainstream finance kind of freaked out when they looked at that credit file because the history wasn't brilliant. With a no interest loan backed by a bad debt guarantee, he was able to pay the £1,000 bill to repair his car. That meant he could stay in work and take the shifts that were going to work for his family and his lifestyle. And with the other £500, he paid off high cost debt and ended up £30 a month better off because his debt servicing costs were improved. There are those kind of stories that we know can make a really big difference. So really excited about this commitment to a national financial inclusion strategy. And to just summarise, the connection through to growth is about making sure that people have the access to the right, and by that I mean appropriate and affordable products and services to enable them to fulfil their own potential and to contribute more to society.
Brilliant. I'm now going to turn to Jane Roderick, who is Head of Group Customer Inclusion at Lloyds.
Hi. Yeah, hello, good morning. So, apologies, I didn't know I was doing this till this morning, so bear with me today. So Jane Roderick, Head of Customer Inclusion at Lloyds Banking Group. I've had a real privilege actually of working on the customer vulnerability and financial inclusion agenda now for a number of years, actually with some of you in the room over that time, which has been fantastic. This is really around how do how do we find those solutions to support our customers? We have 27 million customers across all parts of society, and looking at kind of where meet people where they are, I guess in their daily lives, really finding those solutions to help through the bits and some that Kate's talked about and others. I think for me this agenda is really around how do we find what our role is, but also the role of others, and how do we importantly work together to find those solutions to what are at times kind of complex issues. I think particularly when we're looking at things like affordable credit and some of the other pieces. So I think we'll probably talk about those in a bit more detail, but that's it. Right?
Wonderful, thanks. And now I'm going to turn to Karen Bennett, who is CEO of the Enterprise Credit Union.
Okay, thank you. Good morning, everyone. I hope you can hear me and understand my Scouse accent. So yeah, I'm Karen Bennett, the CEO of Enterprise Credit Union. Our credit union serves, we have 25,000 customers, members in our credit union. We have assets of just on £50 million. I'm here sort of representing the Merseyside credit union. So there's 12 credit unions in Merseyside, and collectively we have over 50,000 customers and over £50 million in assets. So we really are serving a need out in our communities, reflecting sort of, I believe credit unions are a solution, the best solution out there with financial exclusion, and certainly bringing more people into the financial sector. And I think sort of what we offer and the uniqueness of credit unions is that we know our members. We are very much grassroots organisations. We are in the heart of the community, and I think sort of serving our members, we know absolutely the sort of type of barriers that they're facing. It actually pays to be poor, and a lot of our members, and certainly the communities in Merseyside, are paying to be poor. They're paying poverty premiums on electricity, on prepaid meters, so on and so forth. Guaranteed today, they're removing access to cash. So people in the areas there that we're working with are meeting, seeing these barriers day in, day out. But credit unions, I believe, are a massive, massive solution to the problem. We can't do it alone. And so, Jay mentioned about collaboration and working closer with government and other organisations and banks and stuff. So I think it's a great opportunity moving forward that we can do that. I'm looking forward to that. I think sort of, I think there's a lot of asks I'd like to ask of this room, this government, but the big thing is all around sort of letting the likes of the credit unions have a seat at the table and have that voice, and supporting, a number of initiatives out there like the Fair Banking Act, for example. So, that will speak about that further on, but that's me.
Wonderful, thanks Karen. And last I'm going to turn to Torsten Bell, who needs no introduction, but is MP for Swansea West and their exhibition.
I have a vested interest in you giving Karen a clap for finishing. You're a very tough audience. Very hard as it's built to be the last speaker and no one's clapping. You're like, oh god. Anyway, lovely to see you. Always lovely to be talking about this topic. As you say, the government is committed to a financial inclusion strategy, and in previous lives that's obviously something very close to my heart indeed, so I'm glad we are doing that. I thought these sessions can be a bit gloomy, not because of you lot not clapping, although that's not helping, but mainly because the topic's obviously not always the perkiest. I thought we should start on some good news. I'm not going to do the normal politician thing of just bashing the last government and then telling you how great we are, although by the way the last lot were rubbish and we are shit hot. But I thought I'd thank you, good. That's it, come on, we can do this between us. There's only one of you, but keep it up. So I thought, let's start with some good news, okay, for those of us that care about financial inclusion and the state of Britain, which is some of things have got better. Okay, so I went back to financial inclusion discussions when I first was involved back in the 2000s, and definitely back in the 1990s when I definitely wasn't involved, before any of you rudely make a comment. But you'd have been looking at employment gaps being one of the huge problems, parts of the country, including Merseyside, with very high unemployment rates and definitely low employment rates. Those gaps have shrunk hugely. So if you look at places like Tower Hamlets 25 years ago had about a 50% employment rate. Today it's 70%. Okay, and we shouldn't forget those things, because if we don't celebrate the things that have worked and have got better, particularly over longer time periods, then we don't know how we build on that kind of progress. The same thing on wages. If you look at wage gaps between places, hugely down, largely for lower earners because of the minimum wage. So the lowest earners in some parts of the country used to be 25, 30% poorer than low earners in richer parts of the country. It's now about 3%, something like that, that's almost all due to policy, because it can make a difference. That's the minimum wage. Connor is hiding at the back, but used to work at the Resolution Foundation before he went on to, I'm not sure greater, but different things. And it drove lots of that policy thinking, and we shouldn't forget that kind of progress, because if we don't forget that, then everyone gets gloomy and thinks nothing can ever change. So some things have got better, but, and now we'll get on to some of the depressing stuff. Look, the big picture is obviously, why does all this stuff matter so much at the moment? Because everyone's had a completely terrible 2 years. Who is sad enough to have been on the ONS website this morning? None of you? I mean, you're the ones letting yourselves down. So if you had gone onto the ONS website this morning, you would have seen the annual incomes data for 2023. Yes, our data is very laggy. What does it tell you? It tells you that the typical household's income fell in that year. We're used to basically them always growing, maybe not as fast as we would like, but in 2023 incomes fell by about 2.5%. I'm not saying the data's perfect, but that is what's going on. You didn't really need to go on the ONS website to know that, because hopefully some of you have gone into a shop, into Sainsbury's or others. What's happened to food prices in the last 2 years? 30% up. And yes, some people have seen wage rises that have vaguely kept pace with that, but lots of people haven't. If you're reliant on benefits, you definitely haven't seen that. And that is what the cost of living crisis that everyone has kind of slightly stopped talking about. And it's not there in terms of the inflation figures anymore, but is there in terms of the lived experience of people who are paying those higher prices and are living with it. So that's the big picture. Going even bigger picture, like how should we think about Britain today? Well, compared to other countries, say Germany or France, countries we think about ourselves as similar to, we are basically a high wealth, low income country. British households have more wealth than most other European countries, either because we have high home ownership rates relatively, or actually because our house prices are higher and we have private pensions rather than state pensions to a significant degree, but the income side is a disaster. And that is why when a cost of living crisis comes along, food bank queues go through the roof. It obviously doesn't help that the average household on low income has lost about £3,500 in benefit cuts since 2010. Right? So that is why we've got where we are, and that is worth us pondering, because when we come to financial inclusion, we obviously should care about both the income and the wealth side, and lots of the wealth in the financial inclusion space we care about is basically savings. And actually, I mean, generally Brits just don't save anything, right? We don't save anything. If you take the household sector as a whole, we save nothing except for what goes into paying off mortgages. Basically, what we save in terms of pensions, we then run down in terms of pensions. So we're net saving zero, basically. That is not normal. There is some good news, I have to say, which is, and again, this surprised me. If you look at what's happened since the cost of living crisis kicked off, obviously everybody started saving more during the pandemic because you were all locked in your houses, so you couldn't go on your holidays or go out to eat very much. But actually, savings rates have actually stayed, on average, I'll come on to inequality of savings in a second, but savings rates on average have actually been surprisingly high. You told me we were going to have an energy price shock, which would see energy bills double, and households would carry on saving more than they historically have been. I'd have said, that won't happen. That is exactly what has happened. You can see it in Lloyds' internal data, you can see it in national accounts, if that's, again, when you go on the ONS website, which you're all going to start doing now as your morning ritual, then you can see it. And that is definitely, that's surprising. Then just a few things in terms of how we should think about challenges. The panel has talked about, and it's much more experience than I do, about delivering frontline support for people that are struggling. Credit unions in my patch in Swansea are an active part of that. We have several doing a good job, not quite as big as you, but you're a huge credit union, but Celtic Credit Union and others. And then there's the usual financial inclusion thing, which gets most of the attention at the moment, which is obviously on the physical inclusion question, which is like, I can't find a bank, right? Which I get all over the place. The new government is obviously focusing on that. In my patch in Morriston, they'll be opening, I think this is public, if it's not, don't say anything. Up in Morriston, which is the north of Swansea, is opening a banking hub on the high street there in the near future. That will make a difference to some elements of financial exclusion. But I was just going to warn about some other challenges, and we should be really clear about the limits of traditional financial inclusion approaches. So there's the not enough savings, can't access physical financial services. Then there's just the wider insecurity challenge. So you all know there's 1 million people on 0 hours contracts. If you survey employers that use low-paid flexible labour, about 1 in 5 now say that they give people a day's notice of changing their shifts. Right? They made that really concrete in the election campaign. I was knocking on doors actually by coincidence in Morriston a woman came out who worked at the supermarket. I won't name them in case they're here. She basically worked 15 hours a week. She's probably about 55. She worked 15 hours a week at a supermarket, earning some money while she was also had some caring responsibilities. And the day before, she'd had her hours cut to 3. Right? Anyone in this room could cope with that kind of cut in their income? I doubt it. But that's completely legal in modern Britain, and there's not a like financial product answer to that problem. Right? That's what I would gently nudge on. Right? That's about the labour market. It's about how it works, and it's about making sure. So everyone that believes in financial inclusion, which does sometimes become the like sanitised end of the market, should be out saying the traditional way we think about that cannot make a difference when you're talking about income volatility of that scale. You have to solve the income volatility problem, which is why I hope everyone will be supporting the employment bill when we bring it forward in the next few weeks. Just another example: sick pay. Anyone in the room want to venture? If you're sick for a week, if I'm sick for a week, actually I don't know what the rules are for MPs, but in other lives, if I was sick for a week in every other job I've had, I just get paid in full anyway. Right? I get paid in full. I probably carry on working a bit at home or like struggling through, but I'll get paid in full. Or if my kid's sick, I'll get paid in full. Someone who's reliant on statutory sick pay and is sick for a week, how much do they get to live on? Anyone know?
Used to be like 85.
No, it's not, because you've got to wait for 3 days before you get a penny. It's £44 for the week. That's what you're expected to live on current sick pay regime, which is another way of saying you can't. So is it surprising people don't call in sick if they're relying on statutory sick pay? No, because there's not a financial product answer to that. There's a policy answer to that, which is you've got to sort out statutory sick pay. Then just briefly on, it hasn't come up much actually, but what I often hear in this space is, okay, but there's innovative financial solutions which will sort out all these problems, which there are, and they definitely can. And in previous lives at the Resolution Foundation, when I was there, we spent a lot of time supporting ventures that have ideas to help low income households, and some of them are in this kind of space, not many, and they're really important. And some of those people like Karen, you see those happening in credit unions all the time, but lots of the ideas that are in the innovative space have got nothing to do with poorer households. So open banking, which I'm told every 5 minutes at conferences is really relevant to low income households, it's totally irrelevant. It's completely irrelevant. None of the innovations that are being drawing on that beyond this very small number are massively relevant. That's not true, some are, but lots of times I will have ex-bankers coming to see me who've got a lifestyle change, they're setting up a new company, they've got a new innovation, and it's definitely, they're telling me, it's about helping poorer households, and then when you dig into their business model, I'm like, are we defining poorer as living on 40 grand a year? Yes, we are. And that is not what the real world looks like. So do those things, they're really important, they can make a real difference, but let's not kid ourselves that some of that stuff is the answer to big problems. So to leave you the one thing, in the end, inclusion is really important. The government is really focused on it in some areas, and you guys are rightly holding our feet to the fire on lots of other areas, but let's never forget that inclusion isn't a substitute for income, because in the end, that's what matters.
So I'll abuse chair prerogative and ask a couple of questions, but before 30, so do sharpen your questions. I'm going to pick up on where Kate started, which was with economic growth. So obviously, Kate made the case from a kind of economic well-being and kind of mental health well-being kind of perspective. But you started on growth, and it feels like there's a few different channels there. There's a kind of employment line. There's potentially productivity or better job match. Entrepreneurship presumably plays in there as well. I'm curious, Torsten in particular, the panel in general, to what extent do you think that's a plausible case? There's obviously a bit of a tendency to frame things as invest to save for the economy. So to what extent is the kind of macroeconomic benefit as opposed to the micro economic welfare of disadvantaged households kind of a stronger argument?
Happy to start, and I'm sure others will want to come in too. I mean, I think the thing to tie those two things together is to think about the individual circumstances that you're trying to tackle, and then how scalable that solution is and how widespread that particular challenge is. So, the case studies are really important here. When we started the no interest loan scheme, one of those use cases was women who wanted to return to work after having had a child, where the nursery fees up front for someone on a low income were something they simply couldn't cover. They weren't sitting on £1,200 in savings to cover the monthly cost of putting a child into care from 9 till 5. So the no interest loan scheme was, in part, some of those cases were covering that. We've got other examples where people have an opportunity to take a job in an adjacent town where there are no public transport alternatives where they live, and they can't afford to either repair the car or upgrade it. We saw during COVID a huge uptick in the second-hand car market, and that was largely because people who were still doing face-to-face frontline delivery roles really didn't want to get on public transport. But that part of the market doesn't really work for people who don't have a credit file that can be capable of backing a lending solution. And I think you're right about open banking, Torsten. It's not the panacea, but for people who have a really fragmented or problematic credit file, open banking can be transformational, because that transaction history enables lenders to think differently about someone's circumstances. Not 3 to 6 months ago, which is when one of the 3 CRAs might have recorded what you recently did in your life, but what happened last week and what that pattern looks like over 12 months. So that sequence of little things that work when you get the product design right for those individuals can have a huge difference when you scale it up for the number of people that we're talking about. And you mentioned the 1 million people in the gig economy. It's many of those who really are currently underserved and excluded. And you're absolutely right to call out what is the minimum income that they're getting, but the way in which they're served really needs to change. For people who are on shift work, who change from 15 hours to 3, the idea that whatever you've got in your financial services portfolio is collected on a direct debit on the second Tuesday of every month is disastrous. But the payments innovation, things like variable recurring payments, payments on demand, which enable someone to flex what day of the month that payment comes out, could be transformational in someone's ability to partake in those products and for those products to unlock their ability to participate in society. Sorry, long answer.
Great. Torsten? It was a really good answer, because it's also concrete for lots of what people can do. So the honest, I'm quite new at politics, so I'm trying to answer your question. So the honest answer, but I will learn So the honest answer is the direct effect on growth isn't the main reason we should care about lots of things we're discussing. We should, not least because, I really care about growth, right? The reason why wages in Britain haven't been growing is because the economy has not been growing per capita in a meaningful way. So it's rightly, absolutely central to what the government is aiming to achieve, and if we don't achieve that, then the British public are not going to see the change we need them to have felt. But it doesn't mean that everything that's important directly contributes to growth. In fact, lots of ways, I would say. The reason why growth is really important is because it will reduce the pressure on financial inclusion to deliver a decent country to live in. It will alleviate lots of the challenges we're talking about, including some of the ones that Kate has just talked about. So in macro terms, no, it's not absolutely central to growth. It's just really, really important. And we should be doing it for those reasons.
Karen?
Yeah, I think sort of credit unions by their nature are cooperatives, and the money stays in the community with credit unions as well, so I think that helps the economy. I think everyone has got a copy of this on the seats. There's a paragraph there I'd just like to read out, and it says 5 Merseyside credit unions collectively lent £35 million to over 35,000 people, changing people from high cost saving and sort of saving them £120 million over a 5-year period. That £120 million was spent in the local economies here, so that has that knock-on effect as well, with the money staying with credit unions. It stays in the economy as well, not external shareholders taking out the economy as well, so that's why credit unions are good, well placed. So there.
I'm going to take a quick batch of questions, so Torsten have a go at answering them before he runs off.
Or not answering.
Lady here. Yes.
We like this lady, she was clapping. Oh, you didn't get the microphone anyway.
Oh, so who's the microphone going to?
You've got it. Possession is 9/10 of the law.
Indeed, yeah. Sorry about my phone going off, and I thought it was clearly off, and it wasn't. Anyway, so I'm Sam from the Finance Innovation Lab, and the FCA recently you acknowledge the link between financial inclusion and growth, inclusive growth. And we're obviously really pleased that the government's committed to a financial inclusion strategy. So I'm interested to know what the panel thinks the key elements of this strategy should be, including in relation to the Fair Banking Act, which Karen mentioned, which would mandate banks to work with credit unions and others to expand access to affordable credit.
Gentleman behind you.
Robin Fee from the Building Societies Association. This might sound slightly odd, but I think one of the consequences of particularly conduct and ombudsman roles, so conduct regulator ombudsman roles, in increasing financial exclusion by every time there's an enforcement action, every time there's a clampdown on one particular sector, what does it do to the conduct risk appetite of the lenders, and particularly their willingness, for example, to promote ancillary products? So if you're taking out a mortgage, what about the life cover? What about the general insurance? What about the income protection?
Go on, make it concrete. Give us a real one you're anxious about right now.
So those are real. We are seeing firms being more and more reluctant to promote the ancillary services that in the past, when you went to your bank or your building society, you'd have had that advice as well, and that also comes into what is the guidance advice gap that some people are again at the moment.
Okay, and this one here. Morning, Gareth from the Financial Inclusion Centre. So there's never any silver bullets to solve these problems around access to affordable credit and increasing savings, particularly amongst low income. But we have a scalable solution that Karen's credit union epitomises in automated deductions through payroll, but a lesser known through benefit deductions. And so it'd be great to hear Karen's thoughts, and particularly Kate's, around how we can scale that and make that wider to solve some of these problems.
Great. Torsten, do you have a go at those before you run?
I'm not sure I feel massively well qualified, because I think on Gareth's question there's people here who are actually operationalising those things, and they should give you a good answer, apart from agreeing with you that is important. And I see that, talking to people who've used that, who probably hadn't heard of it until they needed it, and then did find it very, very useful. On the benefit side, I mean, you will know this obviously, but the scale of deductions from benefits is one thing that's changed quite drastically in recent years. So people's vulnerability to deductions for reasons that are unrelated to what you're talking about. You're talking about good deductions. It obviously doesn't always feel like that way in terms of, one of the effects of universal credit is that the state is much more effective at collecting back debts, and that's understandable reasons, and that's what the legislation requires, but it's obviously pushing some households into difficult circumstances. But that's obviously not what you're talking about, but you need to think about that wider context which we're operating in. On Robin's question, I mean, the honest answer is that's hard, isn't it, Robin? Because we have seen very significant mis-selling. If I look over 25 years, we can go back into the 1990s, and so there's a reason why conduct regulations have, I agree, become more stringent. I think this is one of those things where people get into a pro or anti volume of regulation, but really it's really about the nature of the regulation. Like, there's no way. Basically, it's easy to have a position on the I want more, I want less. That's not really very useful. It's like, what do we actually want? So I would encourage you to focus on the change, because no, the FCA is not going to suddenly start saying, oh, actually we're much more relaxed about repeats of some of those experiences, but I'm sure are open to conversations, and they're obviously independent of us, so they I'm sure are open to conversations on, okay, that particular bit is having this unintended consequences. I'd definitely be interested in hearing if there are particular parts where the regulation is pushing against that, not least because there are, I mean, in general, there are obviously risks with people buying products alongside other products where there is only one provider coming to them at the time, but there are also advantages in terms of people's lives are complicated, and the more of their life they spend dealing with different organisations, the worse. So that's a fair comment on, I mean, just to cheekily just take Sam's question but totally bastardise it and not answer it. Sorry Sam, again, that's just honesty. Well, there's other people that are going to give you a proper answer before I have to head off, but the general point, which is the challenge for Britain is in a phase where we are a very unequal country that basically people put up with while we were a growing country, and now we're an unequal country that's also a poor country. Both those things together is why it feels like things are so terrible. That's what's ending us up with a world where taxes are at record levels since the war, but public services are collapsing. It's why everyone feels like the country's not working for them remotely. It's what I hear every single day when you're out knocking on doors. So inclusive growth is the challenge, and it's both. We've got to get inequality down, which is what Labour governments traditionally have cared about, but we've definitely also got to get growth up, and that's what, I mean, who knows what's in Keir's speech in a few hours, but like, you know, what is a Labour government that happens to have been elected in 2024 rather than any other time period about? Inclusive growth, that's what we're about. And then hopefully we're going to deliver it. Very good, I better run off.
Thanks, Torsten.
Thanks, Torsten.
Thank you.
Aveek, if it's all right, I'd just like to come in on both Robin and Sam's questions. So Sam, in talking about the Fair Banking Act, you know, referring to one international example in particular, which is the Community Reinvestment Act out of the United States, and Robin's question about conduct risks and uncertainty really brings up, for me, another US example, which is the small dollar loan scheme. And there is, from a Fair4All Finance perspective, a real menu of things that could be done, but the point is there is a big challenge, and the financial inclusion strategy really needs to tackle some big access issues, particularly around credit, around making sure that people can save more effectively, build their resilience to solve mental health problems. And some of the things that we hear from lenders in the market, there have been 150 lenders exit the market in the last 8 years. That's why we've got this big supply gap, is that the clarity is the problem. It's not so much more or less regulation, it is understanding exactly what good looks like, and without having a sense of anxiety that FOS's interpretation of things might change. So the small dollar loan scheme in the United States is 4 regulators getting together and writing out a prescription about what is acceptable and what is not. And that's obviously quite a shift from the principles-based approach that's been taken to date, but it's part of that menu of what might make the difference to enable greater clarity, an appropriate level of risk-taking, and to therefore include more people in the offer. We've also seen the FCA mandate things during COVID, which were a very large-scaled alternative to the pilot I spoke about earlier. So the no-interest loan scheme is always going to be a niche product for people in really challenging circumstances. But during COVID, UK finance figures show us that 27 million people got access through their banks to £500 interest-free overdraft. That was obviously the right thing to do for a particularly challenging piece of economic history, but it's really interesting how when we work collaboratively on things that are needed, there is an opportunity at scale to move at pace. And I think that's the really great call to action in this financial inclusion national strategy that Labour have promised us, to get some of those big things done, and done well, and done for good.
Great.
Sorry.
Are you sure, Karen, do you want to go on the...
Yeah, I'd like just to pick up on Garrett's point there about sort of the benefits deductions and payroll schemes. Credit unions only survive with the members' savings. We don't have external funders coming in. Not nowadays anyway, we sort of, you know, sustainable in our own rights. But encouraging those payroll savings scheme in certainly in local councils, local governments, you know, that not only helps that financial resilience for those people in work, but it creates that pool of money so as we can lend out to the economy. On the benefit deduction scheme, I don't see why it's any different. You know, I don't know why people are treated any differently, whether they're on benefits or a wage, you know, and giving them access to a savings scheme, a small savings scheme, a couple of pounds per week, can help people there. We're not just about lending people money, but they're building up their financial resilience as well. So I'd be a big advocate to push that. Just say that.
Great. And Jane, if you for you to choose from between the which being the financial inclusion strategy, risk of over-regulation, and scaling credit unions, present on that.
I'm just kind of really agreeing with Kate's point on the financial inclusion strategy. Actually, I think I really welcome the task force and the opportunity to bring experts from varying sectors together, or varying parts of the sectors together, to kind of look at the complexities. I know we're talking this on the larger scale things here, but actually when we look at things like access to affordable credit, what is the different roles that the community finance sector takes, that the mainstream banks take, you know, and organisations like Fair4All and others actually, to kind of really look at that access to the right product at the right time from the right organisation, actually. So that would be my kind of my call out, is really to welcome that kind of conversation.
Great. Next round of questions. Lady there.
I was just wanting to, I work in financial inclusion in Derbyshire, so we have quite a lot of issues there. There are 2 areas of Derbyshire where there are no physical banks at all, but we're working on banking hubs and things like that. But really, we're working very hard with our credit unions to try and build those payroll to people to pay in. It's not hugely effective. So I was wondering if there are any hints on how we can sell the credit unions to our staff, is where we're really focusing. Derbyshire County Council obviously has huge numbers of employees. How can we, like, what else can we do? We've got the regular communications going out. We've got, like, when the payroll goes, we're encouraging people to join. But we're still kind of, you know, credit unions are small, and that's part of their joy, that's part of how they are based in the communities, but to try and get volume through is hard. I just wondered what your take on that was.
Can I answer that?
Yeah, go for it.
Yeah, I would say there's various schemes out there. I agree, it is hard to get that uptake. I think if you've got the support of the employers, you know, a lot of sort of employers encourage the staff to do sort of, I wouldn't say mandatory savings, but certainly we have a company we work with who once a year give their staff a £50 enhancement to their shares, so it depends on which way you approach that. I think sort of, we're predominantly a community credit union and it's new for us with the payroll, but I think it's sort of being very clear, simple, you know, it's a good return on your savings you get in our credit union and all the credit unions in the country, you know, but there's massive, like, sort of organised, you know, saving like the whole of the NHS, saving like, you know, saving like the prison service, you know, and it's really, really successful, you know. So like I mentioned the word, I heard the word collaboration there, and I mentioned myself. Reach out through your trade association, you know, the credit unions trade association, and find out the good working practices there. So.
Thanks. More questions?
Can I just say one word on that point?
Please.
Literally opt out. That's the simple way you do it. You basically, when somebody joins the council or whichever organisation, they're automatically opening up an account, and it's a very small percentage, and you opt out of that. And it's been done at scale through Nest, but it's also been done through credit unions as well, and it's really, really straightforward.
And successful.
And successful.
Yes, Pierre.
Can I ask a question? Because I've been at, I think, 3 events where the issue of the Fair Banking Act has come up, and I think it's fair to say, for quite understandable reasons, ministers have swerved it pretty effectively. I'd just like to ask whether, you know, particularly the Lloyds representative, feels that there might be more scope for coordination across the sector to deliver something like it without the need for legislation in what's likely to be quite a constrained legislative agenda.
Jane, do you want to take that?
I'll partly take it if that's okay. I'm not close to the Fair Banking Act or what's in it, so I can't provide a comment. We can definitely take that away and can come back to you. I think if I alluded to where I think you're talking around is the kind of access to affordable credit and how the mainstream banks maybe support and collaborate with that. Let me cover that bit off and see if that then kind of then bring Kate and Karen and hopefully as well. So I think the bit I've kind of touched on a couple of times, very high level around that kind of what is our role, what is the right people, etc., and collaboration. And for us, so one of the things we're doing at Lloyds Banking Group is working with Fair4All Finance, and have been doing that now for a while, with organisations like Aveek, Robert, you're here, as well as Karen and others. We started in Liverpool, actually, in Merseyside, and that is to look at how do we provide safe pathways of support for customers, or safer pathways of support for customers when we can't provide that support. So today we're talking about affordable credit, you know, so we've been working with piloting a scheme that says where we're not able to support the customer, can we work with, say, Fair4All and in this, as a pilot, an organisation called Nest Egg, to provide the kind of fintech support in the middle, but actually provide an understanding of, is there a credit union out there that can support that customer? Can we proactively support our customers accessing those credit unions without them kind of ending up in a, we've declined, they just onward, and it's more distress. So that's why we have a bit in the middle, and the whole purpose of that is around, can we make that scalable? So we've gone very slowly, very learning. I think we've learned a lot along that as we go, just due to the kind of number of complexities and how customers respond to that journey. And we've seen some great results, they're improving as we go. We've just rolled that out actually across all of Wales for all of our Lloyds branches and a couple of parts of Birmingham as well, and are now proactively talking with the sector, talking with Fair4All to go to almost that point to say, is this something that can be tested? It may not be the right solution, but actually this is about innovation and trying to find the right role and where we fit, and our part to play as a sector. So I know Karen or Kate, you've kind of been on the receiving end of some of that, so...
I can go first.
Go ahead.
Yeah, no, I think so. Yeah, it's great that Lloyds are here, and Lloyds have supported our sector for a number of years through the Credit Union Foundation a number of years ago. They help credit unions with some capital, a substantial amount. But I think other areas, Jane's right about the referral scheme, but there's other areas that we're working with Lloyds on, and I think so just having that collaboration, speaking to them, Lloyds have helped us with some training for our staff and so on and so forth, and so it's rolling that out to the other banks and getting them round the table. I think we can develop products, only early days now. We didn't speak to each other years ago, whereas now we are starting to, and I think there's a great opportunity ahead.
And I think just to build on that, I think your point is right about the challenge about the time that it might take to get a Fair Banking Act in place, and Sam has been incredibly diligent about asking these questions in every single panel session that I've been in, which just speaks to the level of effort needed. I mentioned the small dollar loan scheme in the US earlier, and that seems to me to be an interesting, not necessarily alternative, but possibly thing to do first if we think a Fair Banking Act is going to take too long, because that small dollar loan scheme, to my understanding, didn't require a new act in the United States. It required 4 regulators to write down what good looked like, and that has meant that in the US, Bank of America lent 100 million, small sums like less than $1,000. Wells Fargo have done the same, and it's definitely not a panacea, but those loans have gone to people who previously couldn't have accessed a small amount in a crisis, and we know that these are the things that make the difference. I mentioned earlier the Fair4All Finance segmentation research, which has shown that 20.3 million people are in financially vulnerable circumstances. We also know that of those 20 million people, the vast majority, roughly 80%, have a current account with one of the 6 big banks in the UK. And to Jane's point, there are some real challenges around the banking sector being able to provide the right product to some of those, and to have the confidence that the rules are clear enough that that is the right thing to do for someone. We've seen some really interesting patterns around the withdrawal of products as a result of consumer duty, because it looks like someone is overusing their overdraft, and that might be a really genuine problem for that person, but withdrawing the overdraft might be an even worse issue if they can't consolidate the debt that they're left with. So some of the pilots that we're trying to get off the ground around consolidation lending are about how do you help someone with a reasonable amount of debt settle that debt, make sure that it's paid off, that the facility is closed, and to put that debt into a new loan, ideally at a credit union interest rate or a bank interest rate, which will really transform their financial resilience. So, we have a case study of an NHS nurse who had nearly £10,000 of unsecured debt. It was higher rather than high cost debt, but when that loan was consolidated, she ended up saving £290 a month. I'm going to say that again, £290 a month saved. This is someone who was taking home £1,300 a month. So some of those product options, if it's not a Fair Banking Act, could it be a small dollar loan scheme? What's the sequence between a small dollar loan that helps you out, into a consolidation loan that helps sort out the bigger picture. There needs to be that menu for people, and that's why I started with, what do we mean by financial inclusion? We mean access to appropriate and affordable products, and to Karen's point, for people to be aware of those. The credit union sector is doing fantastic things in the UK, but very few people, about 8% of the population, know what a credit union is. In the Republic of Ireland, a third of the population use a credit union as their main bank. So there are some solutions that need scaling and a different treatment along that menu of what's going to work. Sorry again, my answers are terribly long.
Just lots to say. I've got time for a couple more questions. Anyone's keen?
Can I just come back in on that? So just,
if
that's okay.
Yeah.
Just to kind of. So the first part there was just the kind of examples of collaboration. But I guess equally there are, to your point around the scale of different products and services. And one of the things from a Lloyds Banking Group perspective, we now have a check your credit score that's available via the app. You know, early days for us, but we're sort of seeing 10 million people now checking their credit score. I say early indications are actually we are seeing customers then start to build their resilience and improve their credit score, having kind of engaged with that service. So I think there is that range of kind of support and customers being able to engage with their finances. Just about that.
Right. If there aren't any questions, I'll ask another one, which kind of might tie us together a bit. We've referred to the financial inclusion strategy at various kind of points of the panel. I think we've had hints of what we're looking for, but just directly, what does success look like for the financial inclusion strategy? What do you see in there that makes you think we've moved on, or we've made good progress?
Well, for me, it's not just about what goes into it. It's where we're going to be in 5, 10, 20 years' time. Now, I'm really conscious that those of us who have been involved in this topic for a really long time, and it's relatively new to me, I've been in this topic for about 5 years, many people can go back to what was done on financial inclusion with the last task force. And I think we have to ask ourselves why we keep having a go at this every 20 years. So for me, the real litmus test of the strategy is that we don't have to convene numerous panels at a Labour conference in 20 years' time. That's the outcome that we should be striving for. And within what I'd love to see in that strategy, I think we really do have to tackle access to affordable credit with the menu that we've talked about here, the poverty premium, 1 in 4 people paying some form of poverty premium, really challenging particularly around car insurance. The savings point is really palpable. Torsten's right, why aren't we saving as an economy? There's numerous points of analysis about how much more resilience that would build and how much growth that would deliver. So these auto-enrollment options, making sure that when you join an employer, you're not just signed up into the pension scheme, but you're signed up into the savings scheme. Trying to culturally create that norm by making it almost impossible not to. Those are the sorts of really big ticket items that I'd love to see. But again, I'm less fussed about what's in the strategy, just as long as what it's aiming for is that we don't have to come back here in 20 years' time.
Jane, Karen, anything that you're looking for in the financial inclusion strategy?
Yeah, I think so. For me, I agree with Kate. I think that sustainability has to be key within this strategy, and that for me is obviously access to credit, but it's also allowing people within that to access small savings to build up that financial strength.
Jane?
Yeah, we're kind of going back to earlier, I think it is right, and kind of looking at that conversation around what are those right products and services that exist to cover savings and lending and others in between, actually, then making sure we have access to bank accounts and things like that in there as well.
Great. Well, I'll give you a last chance if you've got any final kind of summing up, or I might bring us to a close there.
I think just the last thing I'd say is just to echo one of Jane's points. You know, this financial inclusion strategy needs to be a strategy for the whole of the UK and for the whole of the financial services sector. So we all need to be involved in how this comes together, and I'm really delighted at Tulip Sadiq's commitment to that genuinely being a collaborative effort. This is the moment to really front up and make sure that we've got that clear consensus about what needs to go into it.
Definitely.
Karen, Jane, any closing thoughts? Brilliant. Okay. Well, all that leaves me is to draw us to a close, to say thank you for your attentiveness and for your questions. Thanks to the panel for their expert contributions. And thanks to all of you, and thanks to Fair4All for working with us on this event. Enjoy the rest of your conference, and see you around. Thanks to everyone.